Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 10 of my Path to the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topic. First, banking for women, challenges and opportunities. Second, social responsibility of banks during natural calamities. Banking for women, challenges and opportunities. Banking for women is not just a financial inclusion initiative, it is a socio-economic transformative strategy. Women constitute nearly half of the population, yet historically they have been underrepresented in formal financial settings due to cultural barriers, lack of documentation, limited financial literacy, and gender based economic disparities. Over the years, governments, banks, and development institutions have introduced targeted programs to bring women into the banking ecosystem. From Jan Dhan Yojana accounts to special loan schemes for women entrepreneurs, the goal is to promote independence, entrepreneurship, and financial stability. However, achieving true financial empowerment for women involves navigating multiple challenges as well as harnessing rich opportunities. Opportunities and positives and arguments in favor of banking for women. First, financial independence and empowerment. Access to banking services allow women to manage their finances, save independently, and make informed financial decisions. This builds confidence, enhances autonomy, and reduces dependence on others for monetary matters. When women have control over financial resources, they gain a stronger voice in household and community decisions. Growth of women entrepreneurship. Women focused banking initiatives such as concessional loan schemes, reduced interest rates, SHG bank linkage programs, and priority lending encourage women to start small businesses or expand existing ones. This boosts income opportunities and strengthens local economies. Third, improved household financial stability. Women tend to be more consistent savers. Studies show that households where women manage finances often achieve better budgeting, smoother expenses, and improved long term planning. Banking access enables women to build emergency funds, save for education, and secure health related expenses. Fourth, greater financial inclusion and digitization. Including women in the banking system expands overall financial inclusion. It helps banks broaden their customer base and improve digital banking adoption, especially in rural areas. Women are key influencers in promoting digital payments, microinsurance, and savings products within families. Fifth, social development and poverty reduction. Banking empowers women with access to credit, insurance, pensions, and government welfare benefits. When financial services reach women, overall community welfare increases. Microfinance programs for women have proven to reduce poverty, improve literacy, and enhance social mobility. Sixth, lower credit risk in many segments. Evidence from microfinance institutions show that women borrowers often have higher repayment rates than male borrowers. This makes women-focused lending a viable business opportunity for banks. Seventh, opportunity for banks to build long-term loyalty. Women customers who receive supportive and inclusive banking services tend to show higher loyalty. Banks can benefit from cross-selling long-term products like deposits, insurance, and pensions. Challenges and negatives and arguments against banking for women. First, cultural and social barriers. In many regions, patriarchal norms limit women's mobility, decision making powers, and ability to manage finances independently. Even when accounts are open, men may control them, resulting in low active usage. Second, lack of financial literacy. Women, especially in rural and semi urban areas, often have limited exposure to financial education. This leads to fear of formal banks, difficulty understanding documents, and hesitation in using digital banking tools. Third, limited documentation and identity proof. Women who are homemakers or informal workers may not have consistent income proofs, land documents, or KYC documentation, making it difficult for them to access loans or open accounts independently. Fourth, higher operational costs for banks. Serving women borrowers, especially in rural areas, may require additional staff, coordination with SHGs, doorstep services, and training programs. This increases operational cost and reduces profitability for banks in the short term. Fifth, risk of over-indebtedness in microfinance segments. In some regions, women take multiple loans from microfinance institutions or informal lenders, leading to overborrowing. Banks must monitor such risks carefully to avoid repayment issues. Sixth, digital divide. Even with increasing smartphone penetration, many women still share mobile phones with family members or lack digital illiteracy. This reduces access to mobile banking, UPI payments, and financial apps. 7. Gender bias in banking processes. Unconscious bias sometimes leads bank officials to hesitate before lending to women, especially for business loans. This discourages women entrepreneurs trying to scale their ventures. Balanced comparison. Banking for women presents a dynamic mix of opportunities and challenges. On the positive side, bringing women into the banking system strengthens the economy, boosts entrepreneurship, enhances household financial stability, and encourages broader financial inclusion. Women demonstrate strong saving habits, high loan repayment rates, and long-term financial discipline. These factors make them excellent banking customers and contributors to sustainable economic growth. However, cultural norms, lack of documentation, limited financial knowledge, and operational challenges still hinder widespread inclusion. Banks must invest time, training, and infrastructure to serve women effectively, particularly in remote areas. High touch models such as SHG bank linkage and microfinance require significant monitoring. In addition, digital banking adoption among women remains lower due to limited digital exposure and device access. A balanced viewpoint suggests that the benefits significantly outweigh the challenges, but only when supported by strong policy frameworks, financial education programs, and inclusive banking practices. Empowering women financially is not merely a banking activity, it is a nation building exercise requiring joint efforts from government, banks, NGOs, and the society. Arguments for banking focus on women. Promotes independence and financial empowerment, increases entrepreneurship and economic contribution, supports household stability and long term savings, enhances national financial inclusion, women show strong repayment behavior, helps reduce poverty and social inequality, creates new loyal customer segments for banks. Arguments against and challenges highlighted. Cultural norms restrict women's financial autonomy, lack of financial literacy limits product usage, documentation barriers reduce access, additional operational burdens for banks, digital divide slows adoption, possible risk of over-indebtedness in microfinance, gender bias may affect loan approvals. Conclusion: banking for women holds tremendous potential to reshape the socio-economic landscape. When women have access to bank accounts, credit facilities, insurance, pensions, and digital finance tools, they gain the power to transform their lives, families, and communities. Their increased participation in the economy leads to sustainable development, poverty reduction, and stronger household finances. Yet, progress requires addressing persistent challenges such as cultural barriers, documentation issues, low financial literacy, and limited digital access. Banks must adopt women centric strategies, simplified processes, doorstep services, financial education drives, and tailored loan products to ensure effective inclusion. The government and social institutions must also play a complementary role by promoting gender equality and supporting financial awareness. In the final analysis, opportunity far outweighs the challenges. Banking for women is not merely an economic necessity, it is a path toward empowerment, equality, and national progress. When women thrive economically, societies grow stronger and economies become more resilient. Therefore, strengthening banking systems for women is both a moral commitment and a strategic economic investment in the future. Social responsibility of banks during natural calamities. Natural calamities such as floods, cyclones, earthquakes, droughts, and pandemics severely disrupt communities, economies, and livelihoods. In such moments, banks play a crucial role beyond their commercial responsibilities. Their social responsibility includes providing timely financial relief, supporting government initiatives, extending credit to affected communities, ensuring uninterrupted banking services, and promoting rehabilitation. Banks act as a financial lifeline for individuals, businesses, and local administrations during crisis. While their efforts can create large scale positive impact, banks also face operational difficulties, financial risks, and strategic dilemmas during calamities. Understanding both dimensions, benefits, and limitations is essential to evaluating the responsibilities banks shoulder in disaster situations. Opportunities, positives, and arguments in favor. First, immediate financial support to affected individuals. Banks help victims by offering emergency loans, restructuring existing loans, waiving penalties, and providing moratoriums on repayments. These measures prevent people from falling into an extreme debt or resorting to high interest informal borrowing during distress. Such assistance provides stability at a time when incomes and assets may be destroyed. Second, continuity of essential financial services. During calamities, people rely on ATMs, mobile banking, UPI, and branch services to withdraw cash, receive relief funds, and meet essential needs. When banks maintain operations, sometimes through temporary branches or mobile vans, they ensure that crisis affected communities continue to access critical financial support. Third, support for government relief programs. Governments often route disaster assistance, compensation packages, and subsidies through banks. By efficiently distributing these funds, banks become key partners in outreach and rehabilitation. Their digital platforms enable quick and transparent disbursement, minimizing leakages and delays. Fourth, assistance for MSMEs and small businesses. Banks offer special credit packages to help small traders, farmers, and businesses restart operations. Restructuring NPAs, offering soft loans, and providing working capital support allow economic activities to resume sooner and help reduce long term damage to local economies. Fifth, contribution to corporate social responsibility CSR. Banks often donate to relief funds, provide medical supplies, rebuild schools or shelters, and support community development. CSR initiatives enhance the bank's public goodwill and strengthen its relationship with customers and society. 6. Promotion of insurance and risk protection. By facilitating access to insurance payouts and promoting affordable microinsurance products, banks help families recover faster from financial shock. Insurance coverage reduces the long term vulnerability of disaster prone communities. 7. Strengthen reputation and customer trust. When banks stand by customers during crisis, they demonstrate empathy and reliability. This increases customer loyalty, enhances brand perception, and strengthens long term business relationships. Challenges, negatives, and arguments against. First, increased financial risk for banks. Loan restructuring, emergency credit, and moratoriums lead to higher NPAs in the future, especially if the affected areas' economic recovery is slow. Banks must balance social responsibility with asset quality concerns. Second, operational disruptions. Calamities often destroy branches, ATMs, power lines, and communication networks. Employees may also be affected personally, making it difficult to keep operations running. Maintaining service continuity becomes both expensive and logistically complex. Third, pressure on profitability. Fee waivers, interest concessions, emergency credit lines, and CSR expenses directly affect short term profitability. For banks already struggling with tight margins, balancing social commitments with financial performance is challenging. Fourth, risk of misuse and moral hazard. In some cases, borrowers may misuse relief loans or take undue advantage of relaxed conditions. Moratoriums may encourage willful delay in repayments, complicating risk management. Fifth, limited reach in remote areas. Even with the best intentions, banks may struggle to provide timely aid in inaccessible or severely damaged regions. Dependence on technology also becomes a barrier when digital connectivity fails. Sixth, employee safety concerns. Expecting banks to operate in high-risk zones exposes them to physical danger. It creates ethical dilemmas regarding staff welfare versus public service. Seventh, lack of customized disaster risk products. Many banks still lack specialized products for disaster-prone sectors like agriculture, fisheries, and informed labor. This limits their ability to offer truly targeted relief and rehabilitation. Balanced comparison. Practical assessment. The social responsibility of banks during natural calamities provides essential support that strengthens communities and aids recovery. On the positive sides, banks act as economic stabilizers. They ensure cash flow, distribute relief funds, support small businesses, and other offer credit for rebuilding. Their involvement speeds up rehabilitation and help restore economic activities. For poor and vulnerable populations, banking support becomes a lifeline during emergencies. However, banks face significant internal challenges. They must operate under damaged infrastructure, protect their employees, absorb financial losses, and manage increased credit risk. They also encounter moral hazards, misuse of relief measures, and operational inefficiencies in remote regions. For banks with limited capital strength, increased social responsibilities during disasters can create financial strain. A balanced viewpoint acknowledges that banks cannot ignore their social obligations, especially in a country like India, where formal financial systems play a vital role in distributing relief. At the same time, expecting banks to shoulder all responsibilities without adequate government and regulatory support is unrealistic. The most effective approach involves coordination between banks, government agencies, insurance providers, NGOs, and local authorities. Banks must blend compassion with financial discipline. They must safeguard their balance sheets while delivering relief driven, customer focused services. This dual responsibility requires strong disaster management policies, digital resilience, and specialized training for staff. Arguments for social role of banks. Essential for restoring financial stability during crisis, helps protect vulnerable populations from falling into poverty, strengthens trust in the banking system, promotes faster economic recovery, supports MSMEs and farmers with credit facilities, enables transparent distribution of government relief funds, enhances reputation and goodwill. Arguments against or limitations. Higher credit risk and possible NPAs, operational difficulties due to infrastructure damage, short-term profitability takes a hit, employee safety concerns, risk of misuse of relief benefits, lack of specialized disaster management capabilities, limited ability to reach remote areas. Conclusion. Banks play a vital and irreplaceable role during natural calamities. Their social responsibility extends far beyond providing loans or operating accounts. They serve as financial first responders for communities in distress. By ensuring continuity of services, facilitating relief distribution, offering credit support, and promoting insurance coverage, banks help individuals and businesses rebuild their lives and livelihoods. Effective disaster response from banks strengthens financial inclusion, enhances public trust, and contributes to national resilience. However, banks must navigate significant constraints, including financial risk, operational hurdles, and employee safety issues. Therefore, social responsibility must be complemented by regulatory support, government coordination, technological resilience, and improved disaster preparedness. A balanced approach where compassion is supported by strong systems ensures that banks can fulfill their social commitments without compromising stability. Ultimately, the role of banks during natural calamities is not only a moral obligation but a strategic necessity. A society that recovers quickly strengthens the economy, which in turn strengthens the banking sector. When banks support communities during crisis, they contribute directly to national healing, economic recovery, and long term sustainable growth. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.